Aloha, this is Paul Brewbaker, Principal of TZ Economics, with part four of a four-part economic review of 2025 and setup for 2026. This final installment has to do with the macro dynamics of inflation in Hawaii against the backdrop of U.S. tariff policy in the prior year. This concludes the four-part series, as I mentioned, with segment on labor markets, a segment on housing markets, and a segment on tourism performance in the course of the last year. Inflation did subside finally towards the end of 2025 after a one-year jump in 2021 and 2022 in the aftermath of the COVID recession and at the beginning of the COVID recovery as global supply chains began to be rearticulated. But because of the uneven pattern of production and distribution worldwide, the increase in aggregate demand got ahead of the aggregate supply response in the global economy. And so there was a global inflation, which in Hawaii and the US took the inflation rate up to about 7%. Now we're looking at we're looking at the urban Hawaii CPI in measure of inflation. And I'm comparing it to the US personal consumption expenditure uh, deflator measure of inflation. The PCE is the preferred measure. PCE deflator is the preferred measure for inflation of the Federal Reserve, which conducts monetary policy in the U.S. And so when you hear them talk about their 2% goal, they're really talking about PCE inflation. In 2025, particularly at the back end of the year, you can see that the components contributing most to Hawaii inflation, which as of November had an increase in the overall index around 2.4%, you see here. All of those components pulling the inflation rate back up somewhat. You can see the little zigzag here as the descent was reversed as tariffs on U.S. imports began to pass through into consumer prices. Now, when tariffs are imposed, the first people who have to pay them are the actual importers. But of course, they're distributors, and some of those imports, or even a majority of those imports, are actually inputs to the production of other goods and services. The costs of which then, having gone up, can transmit into final prices to the extent that the producers that are using the imports or the importers themselves don't absorb the additional cost. Tariffs are a tax on U.S. residents. So whether it's the importer or the producer that's using the imported intermediate goods or the final consumer, somebody's paying. And if you look at November 2024, the time of the election and the return re-election, I guess you'd say, of the Trump administration, and the most recent Hawaii number, the November 2025 number, you can see these components: 10% inflation last year in the apparel component, 7%, 6.5% for furnishings, 6% for food at home. A lot of these have heavy import components, and the first two, probably a majority of the apparel and furnishings we buy today are actually imported from the rest of the world because we've distributed production worldwide to where it's most efficient and therefore cheapest to be produced. Tariffs starting to show up. That'll continue in 2026 as an inflation contributor. Just technically, to go back to this point about the PCE deflator, uh, uh, the subject of the Fed's 2% inflation goal, and the slightly higher consumer price index CPI measure inflation, you can see historically going back to the late 1940s that these two measures do track each other pretty well, but particularly when there are inflation surges, because of the nature of the construction of the index, the CPI tends to exhibit more inflation than the PCE deflator does at the same time. And that's been true historically, although I'll note that in the 2021-2022 inflation and deflation, disinflation, um, these measures were actually quite close to each other. And there again is the idiosyncratic Hawaii inflation in 2024. When you subtract PCE inflation from the CPI measure for Hawaii, so subtract US PCE inflation from Hawaii CPI inflation over what is that, 80 years, something like that, not quite 70 something years, you get a differential of about 0.4 percentage points. We can look at inflation expectations for longer maturities. So in the medium and long term, we can look at a direct measure of the market's assessment of inflation expectations by calculating the difference between nominal Treasury bond and Treasury note yields from the uh, TIPS yields for the Treasury inflation protected securities yields at comparable maturities. And I've highlighted the 10-year differential between the 10-year T-note yield and the 10-year TIPS yield. And you can see both before the financial crisis back in 2007, going into 2008, really right up to the Lehman moment, to the collapse of Lehman Brothers and intensification of the financial crisis in 2008, you can see that the market was comfortable with the 2.5% expectation, longer term expectation of inflation, given the credibility of the Federal Reserve's commitment to its dual mandate of price stability and high employment. Subsequent to that and the Fed's policy intervention in 2022 and 2023, inflation expectations very rapidly settled back to this 2.5% range that, as I say, measured by the CPI, is consistent with the Fed's 2% goal. So no changes there, no loss of confidence in monetary policy making. But again, some reminders that exogenous events, whether disinflationary like the pandemic or the Great Recession back in 2008, or in terms of geopolitical risk, like the Russian invasion of Ukraine, something to think about as Trump talks about invading Greenland, could be disruptive with respect to inflation expectations. I mentioned the response to the financial crisis in 2007, 2008, and the Great Recession that it precipitated, involving changes in monetary policy at that time. And so quantitative easing, as we call it, or quantitative tightening, using the Fed's balance sheet to either inject or drain liquidity in much larger amounts than customarily had been associated with the financial system prior to the collapse of Lehman Brothers here, which is highlighted by this vertical line. Those initiatives were created on the fly by Ben Bernanke and Hank Paulson and Tim Geithner when he was president of the New York Fed. Hank Paulson was Treasury Secretary for George W. Bush. Ben Bernanke was chair of the Federal Reserve. And both at the time of that crisis and then subsequently, you'll recall, as the onset of COVID raised the specter of yet another financial crisis, the Fed's balance sheet swelled as the Fed engaged in purchases of assets to inject liquidity into Federal Reserve banks and the Federal Reserve system. And as the pandemic wore off and recovery in the 2020s proceeded, the Fed has been shrinking its balance sheet. Now it concluded its those operations at the beginning of December last year, and so it's no longer actively engaged in these quantitative tightening and easing policies. Instead, it's come back to its principal instrument of monetary policy, which is the overnight interbank lending rate. And you can see here this, dramatic increase in interest rates I mentioned as the Fed attempted to push against the post-pandemic inflation, a more than 500 basis point increase in the overnight interbank lending rate target. that it manages, and with that, a dramatic rise in the entire term structure of interest rates. So from the 3-month T-bill rate all the way out to the 30-year Treasury bond yield. I've highlighted both the overnight rate in blue and then the 10-year Treasury note yield to give you a feel of what the short and long end of the yield curve look like as they kind of move around. And we've seen yields on the 10-year Treasury note back up today to 4.3%, even though the expectation for the overnight rate is that it'll continue to glide downward towards 3% over the next couple of years. Now, that expectation, which was part of the Fed's forecast in September, is still held as of December. So the Fed's still in their in their December projections, they update their projections every quarter, still held to the expectation of a lower overnight rate over time. But you can see how the bandwidth around that, from the highest to the lowest of the projections among the participating members in the Survey of Economic Projections of the Federal Reserve Open Market Committee and the 12 Federal Reserve Bank District governors or their staffs, you can see how that increase in dispersion signifies, even before the saber rattling about Venezuela or Greenland or whatever Trump's doing this week, well before that, partly because the president has begun trying to get rid of Federal Reserve governors that know what they're doing and replace them with Federal Reserve governors that are going to vote his way. You can see that that dispersion is indicative of much more uncertainty about the what the timetable is for lower rates, even though the expectation of everybody is that the rates will continue to go lower. And what that represents essentially is an increase in systemic risk that we can actually observe if you sort of do the math right. So if you look at the difference between the mortgage rate and the 10-year bond yield, which we've been paying a lot of attention to the last few years because it's been so wide relative to the 175 basis point norm of the last 20, 30, 40 years, illustrated here on the left of the screen in blue. You can see that that spread has been coming down. So even though the 10-year yield has come down to 4%, or the neighborhood of 4%, which at 175 basis points would mean that the 30-year mortgage rate could be 5.75%. The mortgage rates have persisted in the sixes, 6.5%, which would be a 250 basis point spread, you see? And now that's been coming down, and there's two components to it. One is what's going on up here, and the other is what's going on in the base. But underneath this is, the foundation of all this is the V-shaped risk premium that's embedded in the 10-year yield itself. And that's part of what's called the term premium, the slope of the yield curve. And you can see that that's, if the yield curve is flat, then the term premium is zero. And it's a measure of systemic risk plus a small inflation risk. Obviously, that contracted. You can see at the bottom of the V here at the time of COVID, despite a quick spike on the way out. It had been coming back to zero, so the yield curve had been flattening right up until the end of 2024 as long-term rates and short-term rates came down. But since the Trump administration's second inauguration, that spread has widened to about 75 basis points. So that's a pure risk premium that's showing up in a number of ways. Here's another couple illustrations. These are both 10-year maturities. There are different ways of doing the math, but this sort of V-shaped path is what I'm talking about. And this jump, about 50 or 75 basis points that you can see here, there's a lot of noise here in the Biden era by this Kim Wright measure, but it's bouncing around. The difference, once the 2.0 Trump administration is in, it goes up and it stays up. So 50, 75 basis points of additional systemic risk. And the question is, where is this risk coming from? It's coming from trade policy, which the president has unilaterally authorized himself to conduct. So the uncertainty associated with what the hell is going on is actually measurable. And in this index that Scott Baker, Nick Bloom, and Steve Davis put together, so you use machine learning to scan 2,000 media outlets for mention of trade policy as a policy concern or uncertainty, or I'm not sure exactly what the large language models are looking for. And an interesting history illustrated here, going back about 20 years, where trade policy was not an issue, not an issue during the Great Recession, not an issue during the first half of the longest expansion in history, the 20 teens. And then you begin to see with the candidacy, the first, Trump comes down the escalator at Trump Tower in 2015, and then with his first election, and then with in 2018 with his explicit unilateral imposition of tariffs and his, eponymous tariff man designation, uh, tariffs which were further uh, aggravated in 2019. So he kept dialing up tariffs on specific countries and specific, metals like steel and aluminum and whatnot, lumber. Um, the uncertainty about where this is all going began to emerge in an environment where it hadn't been present previously. The COVID recession, took that away, and of course, the Trump administration was displaced, and the uncertainty again went back to a relatively tranquil configuration until the Trump 2.0 reelection. And for the last year, this has been a much heightened source of uncertainty. So, risk and uncertainty, we can observe it in the risk premium in the term structure of interest rates. We can observe it directly with these machine learning exercises, and then we can see it in the actual implementation of the tariffs themselves. So I'm illustrating here three moments in the course of 2025, what I call Obliviation Day, April 2nd, 2025, when the Trump administration um, rolled out what they called reciprocal tariffs, which kind of they just made it up. Peter Navarro made something up. And then because of the catastrophe that created in financial markets, uh, Trump chickened out. So the famous taco expression, Trump always chickens out. 1 week later, on April 9th, the administration said, okay, wait, okay, fine. We're going to make it 10% on everybody, with a few exceptions. And that's the second batch of bars you see here that are all lined up at 10%. And then it said, but we're going to give ourselves 90 days to do 90 deals, or whatever they were talking about. And then on July 9th, they said, oh, wait, okay, we need one more month. So then on August 9th, the most of what we now see as the tariff rates on the rest of the world that the U.S. has imposed are illustrated here, uh, you know, by rank order. So the 50% that India is facing and the 40% that Myanmar is facing, et cetera. And I've highlighted some of the relevant trading partners on the left side of the screen. Now, when you put this all together and look at the trade weighted value of the tariff rates that the Trump administration has now imposed on American taxpayers, um, on a trade weighted basis, as I say. So, but the tariff rate can be calculated as coming in at about 17% on average, which is the highest in 100 years, and about what US tariffs were before the onset of the American Civil War in 1861. Okay, so that's where we're at, either sometime around 1933 or sometime around 1861, to put this in historic perspective. And in Hawaii, we're seeing the impact of the tariffs. We saw it in the CPI data, where the components of the urban Hawaii CPI that are pulling the average upward comprise apparel, household furnishings, food at home, things that have a relatively large import content, and where those costs of higher tariffs are beginning to show up in the prices that consumers pay. We can also see this directly if we look at debit and credit card processing data for Hawaii residents. So these are indices of credit and debit card transactions, purchases, going back to the pre-pandemic period. So pre-pandemic benchmark, January 2020, is 0. And over the subsequent 5 years, spending on grocery stores and spending on food services and accommodation went from 0 to 0.2, right, over 5 years. So that's 20% over 5 years, about 3 or 4% per year. So spending was going up over time. And then came Trump 2.0. Then came the tariffs. And spending at grocery and food stores jumped from zero point 0.2 at the beginning of 2025 to 0.6 at the end of 2025. So 40 percentage points. Now, on this one item, which we know is an item that tariffs are going to be showing up in, as opposed to, say, streaming content on Netflix. And if we break down these data even more uh, uh, in a more disaggregated way by quartiles, we break it into 4 groups. So the lowest quartile, the people who spend the least, the people who spent the second least, the people who spent the second most, and then the highest quartile, the people who spent the most. You can see that the impact of Trump 2.0 and the tariffs also presented itself in an interesting way. So prior to the 2.0 onset of the tariffs, the same debit and credit card expenditure data for the lowest quartile was flat to down. See that there's a path there it's not going up. It's probably going down, although it's very noisy. But you can see that in comparison, the second, third, and the fourth, the highest quartile of expenditures, have been going up steadily over the course of 2022, 2023, 2024. As soon as you get to 2025, the second quartile outlays go up, but of course, those are people in the, below the median, let's say. And so only the highest and the higher and the highest quartiles spending continues to go up. What this means is that the rise in prices generally, we saw this in groceries, grocery items, grocery stores, but more generally in consumption as a whole, the ability to sustain the higher costs. And we've got an index here going from, let's say, 150 to, 230, 225. That's like a 50% increase. Here we've got a 40 percentage point increase in percentage points, and here we've got a 50 percentage point or 75 percentage point increase that's not inconsistent with what we observed for the grocery stores, but only for the higher quartiles. And this is an example of what people call the K-shaped economic expansion, where the wealthier, higher income households are able to sustain expenditure, but the lower households are not. Higher prices just lower the standard of living uh, of the lowest quartile. Because they lower the standard of living of everybody to the extent wages don't keep up. Just to wrap up here, it's important to remember the basic macroeconomics of what's going on. An increase in tariffs, an increase in trade taxes on domestic citizens is a supply shock. The decrease in aggregate supply sets up a new short-term equilibrium in which there's higher inflation and lower output. And this is the problem I mentioned the Fed is having to deal with. There's a tension between the two objectives that the Fed has been assigned by the Congress, which is stable prices and high employment. But a supply shock, tariffs, are going to increase prices, increase inflation temporarily, and decrease output and employment. Which one should they deal with? Should the Fed raise interest rates to tamp down the inflation, or should the Fed lower interest rates to keep the employment loss from getting worse? And they've been struggling with that dilemma ever since the Trump administration came into office. And of course, there were other aspects of Trump policy earlier in 2025, the Doge cuts, which would have been a reduction in aggregate demand as well as the tariff-induced reduction in aggregate supply. So it turns out not that much of the inflation has shown up. We're still kind of observing the pass-through slowly as it pushes through out of 2025 and into 2026. Part of the reason it's taking so long is there's a lot of talk about tariffs and then the implementation, Obliviation Day, and then Taco Day, and then August 9th, and then now there's new tariffs. So, when will we know what the tariff is? So it's still playing through, and the pass-through takes even longer. Second thing to remember is that by making importables, so not just the imported goods, but the substitutes that are domestically produced, right? If the point is to raise the cost of imports, so now people buy the domestically produced version, well, that price was higher than the one that the Chinese were making. So either way, you're paying more for the same thing, and that's just inefficient, right? You could have been paying this. That's why you didn't pay this. And now, instead of paying this, you are going to pay this, or somebody's going to eat the difference. And it's just higher cost is inefficient. It means full employment output. It means, you know, the natural level of real output is going to be lower. Other things equal. I'm talking in the long run. Like if the economy's growing on this path, you're going to displace that growth. One-time permanent loss of efficiency. And you may have productivity growth that keeps you going thereafter, but that loss never comes back. So as we're looking at these GDP numbers, we want to be attentive to anomalies associated with the introduction of tariff policy in 2025 and this other issue of, the potential for a loss of real output, like a recession. Now, as I say, the worst expectation either of high inflation or a reduction in output have not manifested in the national economy, although there's no job growth. So that's not a good thing. My colleagues at the University of Hawaii and at the State of Hawaii Department of Business and Economic Development, are forecasting something ranging from mild recession to, modest, not very impressive economic growth for Hawaii as a regional economy. We'll see how it plays out. Just to look at the GDP growth numbers for a second here, the line is the overall GDP growth rate, and you can see by the third quarter it had come back to a relatively robust 4%. We await the final number for the year, but the expectation is that it'll be solid 2 to 3%, no problem. The problem in the data is in the composition. So if you look at what happened as soon as the Trump election was validated in November 2024, importers rushed out to import as much as they could before tariffs were imposed and then implemented. So first quarter imports were huge. People imported way more than was going to be absorbed in terms of capital goods imports and building data centers or something. And in terms of production of using imported intermediate goods for automobiles and whatnot, and in terms of consumption itself, consumer goods. And so those imports went into warehouses. And if you look at the composition of first quarter growth, you have the huge increase in imports, which is a negative for GDP. That's why GDP actually growth was negative in the first quarter. But a lot of it is just stockpiling. So you see a massive stockpiling of inventories, which then reverses itself in the following quarter. So now we're decumulating inventories in the second quarter. And because imports plunge, it actually, ironically, increases GDP growth. Like virtually all of the increase or most of the increase in GDP growth in the middle part of the year, in the second and third quarter, is coming from this collapse of imports, or a significant portion of it. Now you can see that I've decomposed so that consumption, which I want to highlight here, this blue bar, and it's not just domestic consumption, it's exports. So I've put them two together. So domestic and foreign consumption has grown Well, we can look at exports, they haven't grown. So this is domestic consumption. And there's at least one prominent economist at Moody's, Mark Zandi, who's done a deep dive in the data and thinks this might just be, the highest quartile of spenders who are making a bunch of money in the stock market. And so it may not be sustainable is the point as we move out into 2026. And therefore we can't completely eliminate the risk of recession. If you just take out the anomaly, you take out the import and the inventory, the change in inventory components, and look at everything else. Um, this measure of absorption, as I say, which I'm going to take consumption, investment, and I'm going to add public and private consumption, and then investment, public and private capital formation, and then add exports, right? So they're all positive things. Just measure sort of the juice coming from those positive elements, imports being a negative element. You can see that the growth rate was probably not quite 4%, maybe 3%. That's still pretty good. So, we're waiting for the other shoe to drop, both on inflation and unemployment. Final problem with this decline in imports is that the trade deficit did decline, but it didn't decline because we're exporting more. And it certainly didn't decline because of foreign tourism, because that went down because we've, chased away all the Canadians and we're just being rude to everybody around the world. They're like, why would we come to America? And we get picked up by ICE and sent to, Botswana or something. Um, the majority of U.S. merchandise trade, as I mentioned earlier, is actually intra-industry trade. So most merchandise imports are actually intermediate goods or capital goods that are going to be used to build productive capacity or to complete, say, a motor vehicle. And so if imports are decreasing, that means that metals and minerals and rare earth mineral, what are they called, rare earths, and intermediate goods. That means the costs of inputs are going up so much that we're not getting as many of the imported inputs. We maybe are switching to domestic inputs, but those are more expensive because otherwise you would have been using them in the first place. So there's an impairment of US productive capacity to remember that's lurking behind the good news of lower imports. And admittedly, in a services and information produced economy like the US and in Hawaii, it's 90% services, right? 10% goods, 90% services and information. I mean, do we really care what's happening in manufacturing? Well, it turns out manufacturing is also falling in America. And the worst part of all of this is that everybody else on the planet can just go have free trade with each other. Like they look at the U.S. like, fine, go hide in your cave. Ask us if we care. We're just going to make a free trade agreement without you in it. And that is actively happening right now. We have our own problems, and obviously geophysical problems like volcanic eruptions and meteorological phenomena like the Southern Oscillation ought to keep us up enough at night, worrying about when the next El Nino will arrive in a couple of years and whether we have to think about tropical cyclonic risk associated with that long cycle. But my point here is that we've got enough to worry about without having to worry about Greenland. Either way, we better be worrying about Greenland. Until next week, when it will be something else. Anyway, thus endeth this four-part discussion of economic situation here in Hawaii. And you can reach me at Paul Brewbaker at tzeconomics.com if you want to get a PDF copy of the slides or of any of the four slideshows. And by the way, the sources to all the data are at the bottom of each slide if you want to go in and dig out the data and do your own analytics. So, all right, mahalo.